Hey everyone, welcome back to The Explainer. Today, we're diving into a really fascinating piece of the financial puzzle, the Satrix Resi ETF. Specifically, we're pulling data up to July 2026 to put a massive spotlight on this fund's risk profile. We're going to find out exactly what makes it tick. So let's get right into it.
But before we start peeling back the layers of all this data, I actually want you to ponder something for just a second. When you see a financial product slapped with the label aggressive, what does that actually mean to you? Like, does it mean fast money or maybe sleepless nights? You know, the word gets thrown around a lot in the finance world. But today, we're going to look at the hard data to see exactly how an aggressive label translates into actual real-world portfolio mechanics.
Okay, let's dive into this. Here's our roadmap for today's explainer. 1. The aggressive risk profile. 2. Tracking the volatility. 3. Inside the top 10. 4. Sector concentration explained. And finally, 5. Costs and fund mechanics.
All right, Section 1, the aggressive risk profile.
So when you open up the minimum disclosure document for the Satrix resi, the very first thing that jumps out and dictates its behavior is the official label given by the managers themselves. This fund sits firmly on the far right of the risk spectrum. It is aggressive. By definition, this means it's a high-risk portfolio and it has one main goal in mind: delivering capital growth over the long term. It's a pure equity fund. But, and here is the absolutely crucial part, the price of admission for that potential long-term growth is a guaranteed short-term roller coaster ride. The managers explicitly warn that investors should expect capital volatility in the short to medium term. Literally, it's built right into the very DNA of the fund.
Moving right along to Section 2, tracking the volatility.
We know it's a roller coaster, right? So how steep are the drops and how high are the peaks? Well, just look at this contrast. Based on historical one-year rolling periods, the absolute highest return this fund saw in a single year was a staggering 38.38%. I mean, that's the kind of number that makes investors jump for joy. But flip the coin, and the lowest annual rolling return was negative 5.98%. I really want you to ask yourself, how would you feel actually experiencing this massive swing? If you put your own hard-earned capital into this, could you stomach seeing it drop by nearly 6% in a year, just holding on for the chance of that 38% spike? Because that right there is the very real emotional reality of short-term volatility.
Now, what's really interesting here is how time kind of dilutes that extreme short-term chaos. If we look at the annualized fund performance across different time horizons, right next to its benchmark, the FTSE/JSE Capped Resources 100 Index, a really clear picture emerges. Over a one-year period ending July 2026, boom, there's that massive 38.38% jump. But watch what happens as we stretch the timeline out. Over 3 years, it annualizes at 21.50%. Over 5 years, it smooths out even more to 13.35%. And over a 10-year horizon, it settles down at 17.19%. So those extreme one-year returns eventually stabilize. Honestly, this brilliantly illustrates exactly why an aggressive fund absolutely demands a long-term investment horizon.
Which brings us to Section 3, inside the top 10.
Okay, so we've seen the wild swings, but what's actually causing them? To answer that, we've got to look under the hood at the rules governing what this ETF actually buys. The Satrix resi has a super specific mandate. It tracks the FTSE/JSE Capped Resources 10 Index. The rules are strict, and they're pretty straightforward. It directly replicates the index by buying the largest resources companies on the Johannesburg Stock Exchange. And get this, just 10 companies. That's it. This immediately completely removes broad market diversification. It does have a capping rule, though. No single company can make up more than 30% of the index at the quarterly rebalance. That stops one single mega corporation from totally dominating the whole ETF. But still, holding only 10 stocks, that is inherently intensely concentrated.
So, looking directly at the portfolio, here are the top 5 companies as of July 2026. Gold Fields is sitting at a massive 21.52%. Anglo Gold Ashanti is right on its heels at 20.41%. Think about that for a second. Just those 2 companies make up over 41% of your entire investment. Add in Valterra Platinum, Alpha, and Harmony Gold, and you quickly realize that a massive, overwhelming portion of this fund is tied up in just a handful of specific mining corporations. It's kind of like putting almost all your eggs in just a few very specific resource-heavy baskets.
Let's unpack that a bit more in Section 4, sector concentration explained.
We've seen the individual companies, sure, but now we really need to zoom out and look at the broader industries they operate in, because this is the core fuel driving that aggressive risk profile.
When you break down the sector allocation, the concentration is just intense. Almost 39% of this fund is purely in gold mining. Another 28% is in platinum and precious metals, and essentially another 28% is in diversified chemicals. The other category? A tiny, almost negligible 5.9%. This right here illustrates perfectly why this fund is so volatile. If global gold and platinum prices take a sudden hit, nearly 67% of this ETF feels the pain directly and immediately. There's literally no tech, no healthcare, no financials in here to balance the scales.
So, the absolutely crucial takeaway here is this. When you invest in the Satrix Resi ETF, you are not buying the whole market. You aren't even buying a diversified slice of the market. You are making a highly targeted, super aggressive, and heavily concentrated bet on South African resource extraction, specifically gold, platinum, and chemicals. That intense concentration, that is the ultimate driver of the roller coaster volatility we tracked just a few minutes ago.
All right, let's wrap things up with Section 5, Costs and Fund Mechanics.
Now, let's shift gears to the technical logistics and, frankly, the price of holding this fund. I'll give your brain a quick breather from all those complex index rules, and let's just talk about the bottom line. The total expense ratio, or TER, sits at 0.45%. It's a pretty standard but totally key metric for understanding your base holding cost for getting this kind of aggressive market exposure.
Let's quickly round out your technical understanding with just a few more vital details from the document. When you add the actual transaction costs to that TER, you get a total investment charge, or TIC, of 0.49%. Also, keep in mind, the fund isn't just about capital growth. It actually pays out all the dividends it receives from its constituent companies on a quarterly basis, which is currently showing a distribution yield of 2.6%. And interestingly enough, the fund engages in something called scrip lending, which basically means it lends out its underlying securities. Why do they do that? Well, the managers explicitly state this is done to reduce costs and minimize tracking error, keeping the fund's performance as tightly aligned with the benchmark index as humanly possible.
And that, everyone, brings us to the end of our breakdown. We fully decoded what makes the Satrix RESI ETF so aggressively positioned. It's a 10-stock portfolio, overwhelmingly concentrated in just 3 resource sectors, and capable of both massive 38% annual leaps and stomach-churning drops. So I want to leave you with this final, somewhat provocative thought to reflect on today. Knowing the mechanics of this extreme concentration, does your own personal investment timeline, and honestly your emotional tolerance, match this short-term roller coaster ride? Because understanding the structure behind the numbers is the absolute key to answering that question. Thank you so much for joining me for this deep dive explainer. Keep learning, and I will see you next time.